So my name is Olalekan Durojaiye, and I have with me the Professor of Mathematics and Statistics Department, Professor Sahi. So we have in collaboration for this research work. So basically, we'll be speaking to the topic we have here. This came through as a result of what we deem fit as what we need to get into the financial institution as an approach of what might be uh, a strategy to use in overcoming some of the difficulties. So we have this topic, quantifying credit risks in the lending industry. So we practically have to go with the approach of Monte Carlo simulation due to we are unable to have access to the primary data as the case may be, as we already know that that is a very sensitive information. And this led us to using this approach and also to simulate with every assumption that the real life data are required. So, um, so this will be the content I will be speaking to in this presentation. So I have the introduction down to the reference. So just follow along with me as I take it one after the other. So starting with talking about the risk itself, we basically finding a way of how the financial sectors or the lending sector tends to minimize the risk and maximizing the profit. So there is a lot of things involved in giving loan out or credit out to customers. So there's an approach also for the risk management to take in terms of carrying out this process, so as for them to be able to be on a good stand at the end of the day for each of the customers. So starting with the life cycle of risk management process, the risks tend to be identified by the lender, and also having identified the risk, it's very crucial for them to analyze to know the level of the risk. Probably is what they can take, or probably is what on the long run can affect the business. So all these put together will always be considered as one of the major key. And also, we tend to evaluate the risk after the analysis just to understand what is the significance of this to the business and how will this significantly affect the business in a way. So with that, that means during that process of evaluation, mitigation of any risk that might occur through customer credit, we all be paying attention to in order to treat it very well for subsequent uh, loan or credits to give out to customer in the nearest future. So why this is being evaluated and treated with all the strategies applied, they also tend to monitor and review the risks on a daily basis or whatever period they choose to, just to make sure that they were able to cater for unforeseen circumstances. So this is what the introduction is talking about, and also trying for us to make sure that we are able to use our approach to see how we can mitigate a future risk that might occur to the lenders. So we try as much as possible to dig into some of the previous work and to see what method they have applied in the past to mitigate some risk that's come across credit and giving loan out to customer, individual or businesses. So coming from the SIGA 2023, we're able to find out that there is a major 5C approach, which I think that is being capable to understand the kind of customer you are dealing with before you push out a loan, the kind of the capacity in terms of the business the person is running, and also the capital involved. Also, the collateral has always been the major consideration for every lending industry to consider. Some people are taking that as a major key for them to consider from any customer coming to their institution to request for this credit. And there are terms and conditions also involved alongside. So these are the things that has been revolving around what lender industry majorly use to capture risk and see how that can be mitigated. So we build on this and we try to improve from this methodology by adopting what we feel like it's more proactive and can go a long way in mitigating risk. So we also have some other previous study that we also jumped on that majorly focus on using collateral. That is from Yun Lee and Feng 2019. So they practically involve in any customer that has a good collateral before they can give a loan out. So that gives them a sense of how best they can recover their loan from customer in terms of any future defaults. So we're able to pull out two of the literature from our research into this presentation. We still have a couple of them that speak to different methodologies. For the objectives, so we generally have an aim in mind in terms of trying to get the customer profile and to understand if we are or if a customer is qualified for a specific loan. And I think that will help us to run through or to analyze their qualitative information in terms of whatever the name, what they have, where they have worked before, or the kind of business they are running and the likes. And we also have the quantitative data alongside with it, which has to do with some of their incomes and other credit score and other value involvement that we can use to judge if a customer is qualified or cannot default on a long run from any loan acquired from a lender institution. So that gives us a sense of a major key objective that we want to be looking into for this project. So we tend to start with quantifying and mitigating the risk of loan that were defaulted. Probably it's because this happens to be our major point in terms of how do we, from the risk that majorly any customer can default, how do we tend to mitigate the risk, even if we can totally eradicate the the default, but we can as well mitigate on a long run just to avoid it to happen. So we also improve the chance of loan recovery with some of the metrics that we are going to be using in this research work, which help us to actually incur the capital loss that the company or lending industry might be involving in. So those are the objectives we have in mind, and we're able to use that to achieve our aim at the end of the research work. So starting with, like I mentioned earlier, that the method we are adopting here cuts across how we get the financial data in terms of the sensitive nature of it. So we start with the approach to have a simulation of a financial data that is related to uh, uh, the borrowers, any kind of customer that's involved in getting loan or credit from a lending institution. So we start with having a sample size of 500 borrower information, and we use that to generate different variables that involve loans parameters. And we tend to put across some assumption of normality just to ensure that this go in line with the real life data and able to give us the results we deserve. And this can be a relevant information that we can make reference to in terms of using the real life information. So we tend to take it one after the other by creating a table to store the data, and we intend to get some of the variables that were very important in the analysis. So we get the loan amount, we get the interest rate, the terms, and the monthly payment and other relevant information. So we agreed to generate the loan amounts ranging from $1,000 to $50,000. We also get the interest rate. So this interest rate is practically coming from the literature. So the range is coming from the previous work that we review as well. So we tend to have the range of the interest rate coming in this 4% to 27%. Whatever the case may be, we see in the analysis how the Monte Carlo simulation generated that out. So also the loan terms, the monthly, we stick to the monthly part of the loan. And also, we have other relevant information that we consider as well, like loan purpose, borrower information, and loan status itself. So having said that, so that is for the simulation of getting the data and having appropriate information. So we move further by doing the key part of the objective, which is the risk analysis, by adopting a two method away from the 5-6 credits that SIGA used in the literature on the previous work. So this is one of the method we adopted for the risk analysis, debt to income. So which is one of the ratio analysis. And this we have here the formula to that, the total monthly debt by the gross monthly income. So from the data we generated, we should be able to drop this out and use that as a basis to calculate what risk the lender might be involved in and how we can mitigate that. I think there is another one which has to help, which is going to help us, or which has helped us to mitigate or to calculate a method to mitigate the risk that we generated from the DTI. And this is just by knowing the base interest plus the risk premium. So we have an approach to get the risk premium in the analysis, and also having a default base interest rate to calculate that for the RBP. So those are the methods we adopted, and from there we are able to start the analysis with some kind of exploratory data analysis, trying to understand and to know the trend of the data we generated, and also to be able to see if this data is healthy enough to give us some of the information that the objective in this research we capture. So this is just an excerpt from the simulated data. I just pull out 1 to 5 information out of the 500. And from the table, we have some of the information that is being stated that we simulated for. So in our research work, we do not review the borrower information, which is one of the things that must not. So this is just a kind of a simulated information, and probably by convention, this will not be part of what is going now as a research into or reviewing customer information, basically. So this is just here just to show that we have some quantitative information of customer that we can generate it, or we can use that to trace information of the borrowers and get whatever the case may be. So in the generation of the data, we are able to get our loan status. So this is the loan status stating for individual customer, if the customer were approved. or if the customer got rejected. And also in this list, we also have a pending customer. For one reason or the other, the customer can be penned for maybe incomplete information and the like. So having said that, so the total loan that was generated from the 500 borrower happens to be 13 million, or say 13.5, approximately $13.5 million dollars. And we have an average interest of 15.616%, just to have from this interest rate we generated. So also, this is the summary statistics of it, just to have a sense of what is the average loan we got from that simulation and what is the maximum loan amounts. Like we said, we generated from 1,000 to 50,000, so the range is not going over, and that is catering for the major important information. We tend to look that across the interest rates, where we have the interest rate average of 15.16%. And that also explains more of the data we generated following the normality assumption. I mean, catering for some assumption that the real life situation revolve around. And this gives us a sense of what the data should look like. And also, we read through the collateral, seeing the average of what the customer have as a value, the borrower income as well, and everything was well targeted, which give us a sense of, okay, this is good to go to have a good analysis of how we can get this across the methodology. So after doing the exploratory and trying to get the information of the borrowers, and we tend to do some distribution of loan. So we tend to get the customer or the borrower across all the loan uh, category, just to see how the data reflected on what we are giving out. So from the other side there, this is loan amounts by loan purpose. So this is just the kind of a category we have for the loan in terms of the loan purpose. What is the purpose of the loan in terms of what we generated? We have the student loan, we have debt consolidation, we have the house that can go for like the collateral, we have personal loan and the likes. So on the other side here, which is giving us the sense of the loan that has been that was approved and the one that were rejected and the one that got pending based on their loan purpose. And to be honest, this is just on the other side of the approved, because our concentration will be on the approved loan to see how the customer that promised to pay back will not be defaulted. If defaulted, how do we mitigate the risks of this defaulting not leading to bad debt? So that is the major objective here. And we can see that the house and the debt consolidation take a lead of most of the loan that the lending industry approve, because the house can go into the collateral that, okay, if this person have this, we should be able to run after using the collateral information. And as well for the debt consolidation, this is coming from the multiple loan aggregation, just to see how we can combine different loan of borrowers to minimize their monthly payments. And that will help them a great deal in terms of paying back. So these are the involvement, or these are the strategy we use in terms of what the lender industry is supposed to use in terms of approving loan to customer, which are the key part of the necessity for them to approve any customer loan. So out of the 500 we generated, we are able to approve 244 were approved with this loan amounts. So taking into consideration that this is the major key part of what we'll be analyzing the DTI and RBP on, because those are the major parts of our objective. And for every other one, it is normal things to happen that some customer will be rejected, some loan will be pending due to some maybe their information is not accurate based on the requirement. So moving forward, we have the statistics still coming from the previous slide in terms of getting the average loan amount per the purpose and also the number of customers that were involved in this. And this explain more in details what we should expect in terms of what the statistic generated. And so we tend to use that information to calculate the expected payment from the 244 customer we have here. So we tend to have the expected loan amount, which is going into this. We saw that in the previous slide. And also the expected payment that we expected that after applying the interest rate, we expected this to be what we are generating at the end of the day and also having a profit of this. That is an expectation. So we don't know what will happen on the long run. Maybe we are having a default or not. So moving on, we have this information in mind as a business or as a lending industry. And things happens along the line why customer started to be paying back the loan they collected from the lending industry. And we tend to calculate all this information using this approach that we already talked about. So it's just the basic way of how we can quantify the risk that's going to involve in all the loans that we approve. So we can see that out of this approved loan, the 48.8% approved loan, when we analyze the data, we then find out that 103 out of the 244 of the loan were approved, and they promised to fulfill their promise. They promised to pay back their loan. So we got this from the customer as a payback. And for every other one, which is the 57.8% of the loan, were defaulted. So this is what we are not, the lending industry is estimating to get into how they can curb this or reduce this information as against what we have for those that fulfill to pay back their loan. So this default is now the major part of what we are trying to see if we can mitigate the risk to get this a lower number. So this is the visualization just to show the summary of what we have above here coming from the fulfill and the default borrowers. So we have that, and from the DTI analysis, we are able to, our concentration, we have all this information before. So our concentration is on the DTI calculation and also the threshold we have from the literature to know if the customer is defaulting or customer is fulfilling their promises. So we have this analyzed using the formula or the method we explain in the methodology, and we're able to see that if you have a customer that have a value that is less than or equals to 45%, we find out we'll be saying that the DTI is low, and that gives us a sense of a borrower that we definitely pay back the loan from that general observation. For those that have anything above the 45%, tend to defaulted. So that is how the result above came about, and we are able to deduce those customers that we defaulted and those ones that we fulfill their promises. So this is the trend of the DTI, just to show the spike of how these were generated, basically the DTI information. So also we move further from there just to estimate the expected payment and the defaulted loan that will be out there that we are still, in the lending industry, will still be running after. And that will give them a total loss of this, which is outrageous from what is coming from this data we have. So with that, we tend to now look out for how can we mitigate the risk, how can the lending industry find a way around mitigating this rate to reduce defaulters. So this came about using the risk-based pricing, which is the risk mitigation approach that we adopted. So I will just go through the summary of this because of the time, just to give you the sense of what we apply and how this can easily help lending industry to reduce the defaulter that's the data being generated. So we have a general involvement of credit score. We are able to generate a credit score that is ranging from this. So we are using literature to capture all this based on the general credit score that can range from the lower to the high, and see how this can reflect on the loan approved that we discussed earlier. So all this has been taken into consideration. We generate that alongside the 500 and the 244 approved loan. We're able to have a base interest rate of 26%, and the risk premium was added based on this approach, which is also what we use to determine the credit risk by giving all these numbers. And also this can also be found in the literature as we review on our research paper. So we highlighted some of the important information that help us to analyze the RBP. With that being said, these are the columns that were added for the analysis when we were able to get the credit score and the credit score range in terms of if it is poor or low. We are using the 300 to 800, so we have a gauge for this. So the risk premium is also what we have from the literature to calculate if it is an excellent credit score or not. So this is what helps us to use the base interest rate alongside the risk premium to calculate our RBP in order for us to use this to mitigate the risk that involve from the borrower based on the default. You can see that the promise to pay default is major key of what we put into consideration here, just to have a reduction or even at all not to have that involvement of defaulting the loan given out by the lending industry. So, which is basically the findings, and also we tend to have a general conclusion from the Monte Carlo simulation data that we have, which give us a sense of what is expected of a lending industry when they apply this method, debt to income, in order to quantify the risk for them to know which of the customer is going into default, and as well for the risk-based pricing for them to find a way of mitigating those risks that is coming from defaulters. So this approach gives us a good sense of what the data is, what we observe from the data. So it helps us to get a repayment capacity, also to elevate the defaulted risk and all. So every other information is just quantitative information we get from the analysis. And in overall, we tend to understand that if the lender industry adhere to this principle, they can continue to fulfill their crucial role in providing or providing financial support to individual and business, while safeguarding their own business or interest in maximizing profit and minimizing risk. And then we have this reference, just the little part of the reference we use. And also, that is all I have. Thank you so much.